Welcome, everyone. So, for most of this course, we've really been deep in the weeds of accounting, right? The debits, the credits, all the rules that make sure the books balance. But today, we're going to pull back a bit. We're going to shift our focus from the how to the why. We're going to look at one of the biggest decisions a company's leadership team can possibly make. And you'll see how one single accounting entry can tell a huge story, a story about that company's strategy, its confidence, and really, its entire vision for the future. So let's get started. This question right here is really at the heart of everything in corporate finance and strategy. So let's imagine our company, SoftBite. They just had an amazing year, brought in a ton of net income. And that's fantastic, right? That's the goal of any business. But making a profit, that isn't the end of the story. It's really just the beginning of a new chapter. The decisions SoftBite's board makes right now, what to do with all that cash, is going to have ripple effects through the entire company. And it's going to send a very loud signal to the market about what they plan to do next. It's a huge, high-stakes decision.
So when you boil it all down, the choice really comes down to these two paths. On one hand, you can fuel the future. This means you take those profits and you pour them right back into the business. Just think about Amazon in its early days, right? They reinvested every single penny into building out those giant warehouses and developing new tech. That was a massive bet on long-term growth. Then you've got the other option, reward the present. This is where you hand those profits directly to the owners of the company, the shareholders. Think of a mature, stable company like Coca-Cola. They're not trying to reinvent the wheel. They reward their investors with consistent payments. It's a signal of stability. And here's the thing, neither path is right or wrong. It completely depends on the company, its industry, where it is in its life cycle, and its strategic goals.
To really get a handle on how heavy this decision is, we're going to put on our accounting hats and dissect it. The most common way a company rewards the present is by paying what's called a dividend. By just following this one transaction, we can see how it sends shockwaves across the company's financial health and its entire strategic position.
Okay, let's be super precise with our language here because this is important. A dividend is a distribution of a company's earnings. That word, earnings, is absolutely critical. A company can't just pay a dividend using the money that shareholders originally put in. That's a huge no-no. It has to come from the profits the business has actually generated over time. And it's the board of directors that makes the call. They have a legal duty to do what's best for the shareholders, and that means they have to carefully decide if that money is better off being reinvested or handed out.
So, if the profits aren't paid out as dividends, where do they go on the books? Well, they get recorded in an equity account called retained earnings. The name says it all. It's the total of all the profits the company has earned and kept or retained since day one. Now, let me clear up the single biggest mistake students make with this account. Retained earnings is not cash. It's not a pile of money sitting in a vault somewhere. It's an accounting number. It represents a claim on the company's assets. You see, those retained profits have already been spent on things like inventory, new machines, buildings, you name it. The value is already baked into the asset side of the equation.
All right, let's make this tangible. Back to our company, SoftBite. They had a great year. The board met, they debated, and they've made a decision. They are going to declare and pay a cash dividend to their shareholders. The decision is made. So now our job, as the accountants and the analysts, is to see what this decision actually does to the financial DNA of the company. Okay, let's walk this through our favorite equation. Assets equals liabilities plus equity. Take a look at the before row. Before the dividend, SoftBite has assets, including a nice high cash balance, and on the other side, it's got its liabilities and its owner's equity, which includes that high retained earnings balance we just talked about. Now, the dividend gets paid. What happens? Well, first, actual cash leaves the company's bank account and goes to the shareholders. So our cash account, an asset, goes down. That's the left side. Now, to keep everything balanced, something on the right side has to go down too. This didn't involve any loans, so liabilities are untouched. That means the decrease has to come from equity. And specifically, we reduce the retained earnings account by the exact same amount as the cash that went out. So you have a decrease on the left and a decrease on the right. The equation stays perfectly, beautifully.
And this right here, this is the moment where you go from being a bookkeeper to being a strategic advisor. Yes, the equation balances, the T accounts work out. But as future business leaders, your job is to look behind the numbers and ask, so what? What story are these numbers actually telling me? The balancing act is just the start. The real insight comes from understanding what those little downward arrows actually mean for the business.
So I want you to really think about this in practical terms. Forget the equation for a second. It's Monday morning at SoftBite. They have less cash in the bank than they did on Friday. What does that actually mean for the people working there? What cool project might they have to say no to now?
What new risks are they suddenly facing? Let's think about the real, tangible impact of this choice.
The consequences really fall into two main buckets. First, you've got reduced liquidity. Liquidity is the lifeblood of a company. It's just the ability to pay your bills on time, to make payroll, pay your suppliers, cover the rent. By paying that dividend, SoftBite has shrunk its cash cushion. That makes it a little more vulnerable if sales suddenly drop, or if a big unexpected expense pops up. It also means they have less dry powder, so to speak, to jump on a sudden opportunity. And the second impact, which is maybe even bigger, is reduced growth potential. That drop in retained earnings means there's now less capital available for the future. That new R&D project, the plan to upgrade the factory, expanding into a new country, all of that just got harder to fund. The company has made an explicit choice: cash for shareholders today, instead of investing that cash for a possibly bigger payoff tomorrow.
This quote from our source material really just nails it. It's the whole point of our discussion today. A dividend payment is a single transaction that hits two things at the exact same time: the company's ability to operate day to day, its liquidity, and its ability to expand in the future, its growth potential. It forces a trade-off between the now and the next. Okay, so let's start pulling all of these threads together. A dividend payment isn't just some internal accounting entry. It's a public announcement. The company is basically sending out a powerful signal to everyone who's watching: investors, competitors, Wall Street analysts, you name it. Every single dividend decision is a form of communication about what the board is thinking and where their priorities really lie.
So let's recap the big takeaways here. First, a dividend is a clear financial choice. Give it away or reinvest it. Second, it has a direct impact on day-to-day operations by reducing cash. Third, it absolutely shapes the future by limiting funds for growth. But maybe most importantly, it's a message. It's a signal to investors about the company's priorities and its confidence. Now, reading that signal is the real art of financial analysis. For a big, stable company, a dividend can signal strength. But for a young, fast-growing tech company, a dividend could actually be a bad signal. It might suggest that they've run out of good ideas to invest in. Context is everything.
And that brings us right back to where we started, but hopefully with a much richer understanding of what's at stake. Do you reward the investors who support you today, or do you fund the growth that will define you tomorrow? There is no easy answer you can look up in a book. This is the classic, enduring dilemma of corporate strategy. And as you move forward in your careers, I promise you, you will face this problem again and again. You might even find yourself in a boardroom one day, making the case for one side of this exact debate. Your job will be to use the clear language of accounting to lay out the trade-offs, but the final call, well, that's going to take more than just numbers. It's going to take leadership and judgment. Thank you.